Alibaba Group is back at the center of market chatter as multiple narratives collide. Delayed earnings timing, geopolitical turbulence, AI infrastructure risks, and valuation debates. Earnings delay and Pentagon listing confusion. Investors are actively debating Alibaba's persistently delayed earnings report date, which some interpret as routine scheduling noise, while others see it as a potential red flag amid heightened regulatory scrutiny. The uncertainty has amplified speculation, particularly following reports that the company had been included on a Pentagon-linked list of firms allegedly connected to China's military, a designation that was later retracted. While the retraction removed an immediate overhang, the episode reinforced a broader theme. Geopolitical risk remains embedded in the Alibaba story. Even when specific headlines fade, the risk premium doesn't fully disappear. AI chip restrictions spark sharp sell off. The more immediate catalyst for the stock's recent weakness, however, came from escalating US AI chip export restrictions. Fresh reports indicated US plans to cap shipments of NVIDIA's H2000 AI chips to China at 75,000 units, a move seen as directly impacting Alibaba's cloud and AI ambitions. As a result, Alibaba's ADRs gapped down more than 5%, following a 4 to 5% slide in its Hong Kong shares. The drop mirrored a broader 2.9% plunge in the Hang Seng Tech Index on heavy volume, signaling sector wide de risking. Because Alibaba Cloud relies heavily on advanced GPUs to train and deploy large scale AI models, any restriction on high performance chips raises concerns about competitiveness, particularly against US hyperscalers with unrestricted access. Adding minor pressure, a securities probe announcement from Portnoy law firm surfaced on March 2nd, though most traders viewed this as secondary noise compared to the chip export story. Meanwhile, global markets showed broader risk off behavior, with capital rotating into energy stocks and the NASDAQ down roughly 2%, reflecting macro de risking rather than company specific weakness alone. Middle East conflict and macro spillover. Traders are also watching escalating conflict in the Middle East, assessing potential ripple effects on oil supply routes and broader US China relations. Any sustained energy shock could tighten financial conditions globally and weigh on emerging market equities, including Chinese tech names. For Alibaba, which operates across commerce, logistics, and cloud infrastructure, macro shocks can affect both consumer demand and enterprise spending simultaneously. Margin compression fears. Beyond geopolitics, investors are scrutinizing Alibaba's cost structure ahead of earnings. Two areas are drawing particular attention. One, massive AI infrastructure capital expenditures. Heavy investment in GPUs, data centers, and model training capacity may pressure free cash flow in the near term. Two, aggressive quick commerce initiatives. Alibaba's push to faster logistics and delivery services is seen as strategically necessary, but margin dilutive in the early stages. There is growing concern that these initiatives, while critical for long term positioning, could lead to significant margin compression in upcoming quarters, potentially disappointing investors expecting a cleaner profitability recovery. Bull versus bear divide. The community is sharply split. The bull case: Alibaba remains deeply undervalued relative to global peers. AI model advancements and cloud scale provide long term upside. Geopolitical headlines are cyclical and often overblown. Recent sell offs reflect forced de risking, not structural deterioration. The bear case: US China tensions create recurring headline risk. AI chip restrictions could structurally limit competitiveness. High capex and logistics expansion threaten margins. Earnings uncertainty fuels volatility. At its core, Alibaba's current volatility reflects a broader tug of war between long term AI transformation potential and short term geopolitical and macro headwinds. The next earnings report, whenever officially confirmed, will likely be pivotal in determining whether the narrative shifts back towards AI driven recovery or remains dominated by external risk factors.
Okay, so we have this piece here from the folks at Schaefer's Investment Research, and they're saying that as of Monday the 2nd, that stock was within one standard deviation of its 260-day moving average. Now within 0.75. Okay, it may have actually gone beyond that. So what we do is modify this moving averages and make this one 260. This one we'll make it 260. Let's see, 260 to see where it lies. Yeah. So it is. Yeah, I think you can still say that it is still within within one standard deviation, I guess. Okay, and it says here that after remaining, okay, it's now within 0. Okay, 20-day average to return. It's now within 0.75 of the 260-day moving averages to 20-day average true range after remaining above it 80% of the time in the last 2 weeks and 80% of the last 42 trading sessions. This signal has occurred six other times over the last 10 years, after which the security was higher 1 month later, 67% of the time. All right, let's see how it goes. Okay. So you see this link in the description box below so they can digest more. Okay, so okay, it's saying that we might see a bounce. Okay, that's what we can see here. The extrapolation is saying that after 1 month, it's saying that may well be what may happen. You can see the extrapolation is saying that by the 13th of April, it may see a bounce. Okay, yeah, that may well be what may happen. Okay, so let's return this to the 200-day moving average. Okay, so the extrapolation is saying that okay, the stock is actually consolidating within a longer term bullish trend. 200-day moving average, I think, is okay. Let's just say neutral to bullish trend. Yeah, the stock is actually consolidating. Technically, it is consolidating, even though it has been showing a lot of weakness since then, since the 29th of January. Yeah, but still consolidating technically because we have a mix of moving averages. Okay, the leading moving averages are still above the slowest moving average, so it's a consolidation we have. But in the midst of all of that, the extrapolation we have checked the moving averages, the 10, 21, 40, and 200-day moving average. They're all aligning and pointing in the same direction. Yeah, for some reason they are all aligning. Even we have also checked the weekly chart. There, it's also aligning as between now and the 16th of March. There's an alignment. It's saying here that this weakness may remain in place up till the 11th, and then by the 16th of March, it would have bounced. And that is also what we have on the weekly chart. But in the midst of all of this, let's see. The projections are saying 146.96. It's a pivotal projection. It was actually printed when it was initiated when the stock was at let's see when the stock was at let's see when the stock was at $169.92. It was initiated and it has printed it. We have for some reason these algos, they just whenever they project a downward projection for some reason it just prints. But we've also noticed that it keeps on insisting on it retesting it. So what's the probability of it retesting this 146.96? What's the probability of that happening? 146.96. Yeah, very high, statistically very high. I'm looking at the strip here. It holds the moving averages. If the moving average is greater than the projection you're considering, then or the target you're considering, then you know you have the probability that is greater than 50%. So that's what we have. Yeah. So the stock is currently trending right now. Just see what you make of the stock, and I'll continue to update you. Thank you very much for watching this video.